Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, national underwriter for Old Capital, and always joining me, it's Michael Becker.
Hey, Paul.
Michael's also with Old Capital. Welcome to the podcast. In the podcast today, Michael, we have a celebrity. Did you know that we have a celebrity in the podcast today?
I did not.
Well, the celebrity is pretty much world famous. You know, if you do a Google search on this guy, you'll figure out how famous he is. He is famous for a couple things. Let me see if I can go to my legal pad, read some of these things. He is famous for the Lone Star pork handle. The Lone Star pork handle. Mm-hmm. He's also famous for the fried Thanksgiving dinner.
Wow. The
fried Thanksgiving dinner. And also the State Fair brew funnel cake.
Wow, I did not know all that.
So, we have a celebrity in our midst, and I want everybody to meet the celebrity, Justin Martinez.
How are you guys?
Doing well.
We're doing good. So, the celebrity of the hour is Justin, and Justin is going to talk a little bit about what he has done recently in the multifamily business, but he is a celebrity because he is a famous state of Texas fair. I guess the great state of Texas fair.
State Fair, Texas,
That's it. He's the guy who comes up with all the fried food ideas, the things that people, whether it is, well, you tell me all.
Sure. So, been in business. My dad started the State Fair, Texas in 1978. And being born in 1980, I was basically raised at the State Fair. And so it's in my blood, business and the State Fair. It's, you could say carny, but I really don't like that term. Carny, but hey, listen, if it generates income and allows you to do what you want to do, I enjoy doing it. So basically since 2003, I've been with the State Fair, Texas after college, and joined my dad and started to dive into this fried food business and understand it. And then when I realized how much revenue it generated, I got pretty excited about it. And then about 10 years ago, they started this Big Tex Choice Awards. This is where all the concessionaires come together and pretty much put some fried food ideas together and see who wins. Well, I really didn't care about it at the time until I realized how long the lines were and how much money it generated. So I said, you know what? I think we might be interested in. So that's when we got in our kitchen, started coming up with crazy fried ideas. And then we've won the last 3 out of 5 years. And wow. I tell you guys, we're going to win again this year. So we're pretty excited that
you have heard it here.
Yes, heard it here first that we are pretty excited about our new item this year, but very excited about the 2016 State Fair.
So a lot of people listen to podcasts aren't here in Texas or especially in DFW where the fair comes in every year. Maybe you quickly give a little background on the fair and kind of the size and scope of it so people kind of understand how big this is.
The State Fair, Texas is the second largest state fair in this country. Generates over 3 million visitors in a matter of 24 days. And it's been around for 200 plus years. And so it's a tradition here in Dallas-Fort Worth, as well as for Texans, to come to a state fair that has everything from your typical midway to your fried foods to your livestock. It's one of a kind fair, and I'm just proud to be a part of it.
So what were the 3 things that you guys have won with?
Okay, so we won with actually fried bubblegum. That was about 4 or 5 years ago.
Fried bubblegum.
Fried bubblegum. Then I said maybe come up with something a little more enticing in future years. So fried Thanksgiving dinner. It was another one. And then funnel cake ale. It's a beer that it tastes like funnel cake and has a powdered sugar rim. So when you taste it, it has that buttery flavor to it, doughy, and then you get a hit of that powdered sugar, and it's a complete funnel cake experience in a beer.
That's great. So when is the Big Tex Choice Awards?
Big Tex Choice Awards is September 1st, right around Labor Day. And so keep an eye on TV and radio because I think you might hear my name once or twice. I typically don't act that way, but we are confident that it's going to do well this year.
So Justin is a big fan favorite for every Texas cardiologist.
Yes, exactly. But what I like to say is it's only for 3 weeks. So after that, go back to eating healthy.
That's right. So let's talk about something that you're also getting a reputation for too, and that's ownership in multifamily. So I thought we'd kind of talk a little bit about your last transaction, a little bit of your history, how you got into the multifamily business, and so I'm going to kick it over to Mike a little bit.
Yeah, so you obviously have been running a food service business for, like you said, 3 weeks out of the year. I'm sure you have a couple of months prep leading up to it, but maybe just talk a little bit about that. So you kind of were born into the family business, and now you've kind of decided to transition in the other 11 months out of the year into doing real estate kind of full time. And I'm sure you're kind of in a unique situation where your business is pretty flexible and allows you a lot of downtime most of the year. So maybe kind of talk a little bit about that, kind of how you a little bit more about your business background and why real estate and kind of how you got into it.
Sure, absolutely. So coming from the background of the state fair, I understood that I like the idea of having free time and being able to work 2 months out of the year and generate enough income for our family for the whole year was very enticing to me. And I looked. Once I realized that's a great business to be in, I searched for other types of businesses that are very similar, that allow you to have free time to do travel, to be with your family, that you're able to manage and manage with key team members to allow you to do that. And so with real estate, after reading, Rich Dad, Poor Dad, it was a great book I love, and it's on the shelf today in my library, is that I understood that real estate allows you to do that. It's more passive, not necessarily fully passive, but it allows you to not have to work 40 hours a week. So that, back in 2004, I said, you know what, I want to get into real estate to start putting some of this money that I made from the state fair into assets that I could enjoy and understand. So I did single family since 2003, and about in 2013, I realized that this is something that is just too slow for me. It's not generating the income and the lifestyle I wanted, and I knew that it was going to take a lot more work and effort if I wanted to get there. Then I basically, through a local organization, started seeing multifamily. Well, at the time, my mindset wasn't set to say I could do multifamily. It was I could only do single family. So it was a battle for me to transition my mindset to say I can go from single family to multifamily, especially with the resources I have and the money. Didn't think it was possible. But through some mentorship, I understood that it was possible, and through a peer group that was doing it, it allowed me to transition my mind to understand that, multifamily is something that I can do. I have the skill set to do it. And in 2014, that's when I decided that I was going to pursue multifamily and go all in.
So taking a quick little step back, how many little houses did you end up doing over about almost a 10-year period?
Up to 14.
14.
Yeah. And then that's when it started getting a little dicey of calls and having to manage these single family units. And I realized this wasn't what I signed up for. And so then I was a little discouraged. I was like, this real estate thing is not really what I'm wanting to do. Yes, of course, I create cash flow and some equity down the line and appreciation, but it was too slow for me and too timely intensive as far as me being involved in it. So that's when I started pursuing another avenue, and that's when I discovered that multifamily was an option.
So basically what attracted you to multifamily was essentially just the fact that it was a scalable business, that it was less time intensive, less management intensive on you as the owner, and that you can really kind of just grow and get bigger at it. Is that essentially what it was? Yes.
Once I understood what the economic scale of multifamily and the numbers and the ability to leverage other people's money, leverage other people's time, have a team in place of brokers, managers that were more skilled in key areas of the business, showed me that now I'm a business owner and I'm managing the team and not necessarily managing the actual everyday operations of the business. So once I discovered that, I dug in and decided that I wanted to learn as much as possible in this business and make it my... Once I decided, I said, this is what I'm going to do, multifamily and no other type of business. And so if in 2014, I said multifamily, and then 10 years from now, I'm going to be doing multifamily as well.
That's great. You mentioned you joined a local organization, got some mentoring. Mm-hmm. Maybe talk about that, and then kind of talk about your first transition to your first property. Was that a passive deal, or were you a lead investor in it? And kind of talk about the beginnings of it.
So back in March of 2014, when I decided that multifamily business was going to be my go-to with real estate, I knew that just from experience that education was going to be critical, and the ability to understand the business. And knowing that I was going to be in this business long-term, I took it at a pace of education, and then eventually understanding that if I'm going to be a deal sponsor, I'm going to do this business correctly. And in order to do this business correctly, through education and being a part of a deal passively, just investing my money into another deal sponsor's deal allowed me to understand this business. I think too many people out there, they try to jump in this business real quick. I want to be a deal sponsor and I want to get in immediately, instead of saying, hey, what's the long-term approach? Do you want to be in this business 5 years, 10 years down the road? Well, let's get educated first and understand how this business works. Put some money in as a passive, see how the deal sponsor communicates with you, and so you can start to learn this business. And so that's what I did in March of 2014. Joined a mentoring, started my education. Back in July of 14, became my first passive deal in a property called Jane Lane Apartments, just to see how this business works. And so pretty much built up from there as a passive up to that point.
So maybe tell us a little bit about the Oaks of Jane Lane.
Sure.
Kind of what's the property, where's it located?
So Oaks of Jane Lane is in Haltom City. It's 109 units. That back then I was not as educated I am now, so it was kind of a faith. I went into the deal based on how I felt about the deal sponsor, knowing that I felt that this guy had integrity and he was going to be able to take care of this asset. And so jumped in that way, and it's been a success. He's been a great deal sponsor. He communicates with us. He understands assets. He's been in this business for longer than I have, and so it was a great mentor of my own to be able to get key information. I'd ask him questions, more than a typical passive investor would do, just so I understand the investment. And then just recently, we have been in this deal for a little less than 2 years, and we refinanced, and we'll be getting 100% of our investment back. So basically doubling our money in 2 years, which was amazing.
It's pretty amazing, Paul, huh?
Yes, it is.
And who gave him the loan on the refinance, Paul?
It was Old Capital, of course.
Yes.
So the reason why they came back to refinance that property and they pulled cash out is that 2-3 years ago, when they did buy that property, they had to assume the current loan that was against the property. So that loan had a pending maturity. So it had to be paid off. And so, they got their cake and eat it too, so to speak, in the food guy sitting next to us here. So they had an opportunity to refinance the property and pull some cash out to do distribution to their investors in the deal. So they got a Fannie Mae loan, gave them cash out up to 75% leverage in the transaction, 30-year amortization, 10-year term, rates in the mid-4s or so. So with the cash out, now that they're reset, and if they want to keep that loan and that property for the next 10 years, they're good to go. So all non-recourse type of stuff.
That's good. So after that, you did one more deal as a passive before you decided to go into lead your first on your own. Mm-hmm. Tell us maybe just real briefly about that deal and why you decided to do a second deal as a passive instead of trying to lead your own?
Yeah, so I just felt that we had money to invest. I'm partnered with my dad, and so he helps me in this business. I'm more of the operational guy of getting in deals. But yeah, so I just felt that I needed to extend to my resume, show that I've done a few passive deals, as well as see how it looked from another deal sponsor's point of view and how they communicate with me and how they send out their monthly reports, and just to get a different perspective on how things are done, and just to build my confidence up of being ready to be a deal sponsor. And so that was the reasoning. I basically did a second passive deal.
Yeah, and I'm a very big believer in taking baby steps into this business, is jumping in like Justin did as a passive investor, kind of figuring out how you want to be treated, so how you want to treat your investors on your deal when you have a chance to get to, the cockpit, to be the captain of the airplane, so to speak. So I definitely like taking baby steps. So let's keep moving on this conversation.
Yeah, so what was that second property you invested in?
Las Brisas in Garland.
When did you close on that?
That one was the end of 2014. Okay. I think it might have been early 2015, but pretty much around that time.
So about 6 months after the first one or
Correct.
So. And then the first deal you decided after you did Las Brisas, so you felt like you were okay to take the leap forward and lead a deal on your own, and that was a Highland Oaks property?
Yes. So back when I made the decision, okay, I'm ready to leap to a deal sponsor, Dallas-Fort Worth was my ideal area to obviously be a deal sponsor, but I felt that I had the opportunity through my business of being able to only work pretty much 2 months out of the year. My flexibility to go to other cities allowed me to have a competitive advantage, and that's when I started researching other cities that was around a 3-hour travel span from Dallas-Fort Worth. And so from doing that, if you ever do that, it's not very much of not many very locations that are actually, you got Waco, Houston's right, about right there, and a few other areas. But I was just attracted to Oklahoma City just for the fact that I felt like there was going to be less competition. It was a city that was stable. It's not as hot, obviously, as DFW, but I feel like it's a area that I could compete and it would have sustainable growth long term. And so once I made that decision, then I started traveling there and started building those relationships with brokers, with property managers, and try to understand this market where I'm going to get into. And so back in, I think it was March of 2015, this is when we came upon Highland Oaks, brought some partners in with me because this is, like I said, a team sport. But once we found Highland Oaks, we put an offer in, and unfortunately we weren't the highest offer and got beat out by another offer. So this business, I tell you, it's something that you have to continue to move forward, and you're going to have times where you're not able to get all deals, and you're going to make offers and you're not going to get the deal, but you can't get discouraged. So we just continued to put offers on other deals. But Highland Oaks came back to us. The deal fell through on the first buyer, and we're second in line to get that property. So back in, I think it was June of 2015, that's when we got that one under contract, and then I realized this is for real, and it was showtime.
So maybe talk a little bit about it. How far is Oklahoma City from your house?
So from Arlington, Texas, Oklahoma City is about 3 hours,
about
3 hour drive. Yeah. Okay. So typically what I'll do is get up at 7 a.m. and I try to beat traffic before, and then I'm there after about 10 a.m. And that allows me to visit properties, visit Highland Oaks, and so it's not that far. It's a pretty easy drive, and then I'm coming back in the afternoon. So it's not as difficult as some may seem.
Okay, that's good. So you guys got the deal. You're initially disappointed, and then it came back around. Maybe tell us a little bit about the type of property that you were targeting. Was it like a stable property? Was it a value?
So for my first deal, I was looking more for a stable property that produced cash flow with very little deferred maintenance. I didn't want to get into my first deal that had a huge rehab that required me to be on site with management to do this, the rehab. So I wanted something that was pretty turnkey, that was already stabilized, 95% C-class property in a blue-collar area. And so that's what Highland Oaks is. It's in a little suburb of Oklahoma City called War Acres. And it's an 84-unit apartment that consists of larger townhomes with a predominantly Hispanic demographic. And at the time of purchase, it was around 96% occupied with very little deferred maintenance. Our rehab budget was mainly for interior upgrades. And so that allowed me just to focus on understanding this business as a deal sponsor. And it was an easy transition and pretty much maintaining what it currently is doing, and then at the same time doing unit upgrades and trying to do a value add through additional rent through those unit upgrades.
Got it. So the capital you had, obviously you said you brought some partners in on the deal.
Right.
So maybe talk a little bit about that. So
sure.
You go into this deal and you did, you needed whatever you needed to close hundreds of thousands of dollars to close this deal. You didn't have that ready in the bank to go. So maybe kind of talk through that. How did that mentally, how did you get there? And then how did you actually tactically go out and get the deal done?
So let's take it back to 2014. So 2014, one thing I understood in this business is not only it's a team sport, it's a relationship business. And that meant that I had to build relationships with not only management companies, with brokers, but with passive investors that when it come time for me to execute, that they could trust me to invest in. And so basically from 2014 till that time, I was constantly going to meetups, going to groups that had passive investors and build those relationships. And it's key to build those relationships before you need something. And so through building those relationships, about a year from then, I was able to feel confident that I was able to execute my own deal. And so when I had this deal in front of me, I was able to communicate with them what the expectations of this property were. They already felt comfortable with me. And so then I was able to bring them on and raise over $1 million for this deal. So
that's pretty amazing.
How long did it take you to raise the $1 million?
At that time, since I was new and was in Oklahoma City, probably a little over a month, probably a month. Yeah, 1 month.
That's not too bad. A lot of people thought that they would probably want to diversify a little bit outside of Texas, and that property was a little bit of an older property. It was a stabilized property. The work had been done to the property by the previous ownership group to kind of put it back together again?
So being a stabilized property, 95% value, the owner focused on taking care of all deferred maintenance. So all units that were available were your standard carpet, paint, no upgrades at all. And so that's where we had identified where the value was. Is that where you're asking?
Yeah, and the financials were in place too. So you could you saw the history of how the property had done. So sometimes these older, smaller properties, and this really wasn't that small of a property, but the older properties sometimes have mom and pops that the operating statements are a little bit of pieces of paper. But this one, you were able to kind of figure out, where it started, where it ended right before you bought it. So it helped you and helped the lender kind of understand that this was a stabilized property and that your financials were good financials.
Absolutely. So and part of my business plan going into it for my first deal is I wanted a non-recourse loan, Freddie or Fannie. And so knowing that was my criteria, that's where Highland Oaks fell. The owner kept the books clean. He used a nice program that allowed us to see the financials on immediately through either a rent roll or a P&L, profit and loss statement. And so having the owner being organized and on top of the property allowed us to easily apply for a non-recourse loan.
So you got the non-recourse loan. So you were the captain of the airplane. You put the whole deal together. How many other KPs or key principals, first officers that signed with you, how many did you have?
2 others. So knowing that this was going to be my first deal, I knew that I needed a strong team.
Right.
And so my other 2 deal sponsors, KPs, were strong deal sponsors themselves that I knew that had the experience, had the net worth, had the liquidity to make this happen.
So Fannie Mae really looked at their balance sheets and their history more than they looked at you in the deal.
Absolutely.
So by putting together a team, Justin was able to get the green light from Fannie Mae to get the transaction done. You guys closed on the deal. Took you, about 45 to 60 days to close on that deal?
Correct. After due diligence, about 45 days. We closed on September 3rd of 2015.
And what did you find on that property that you did not know a month or 2 months or even 6 months later that you think would be important for people to kind of understand, maybe a surprise or maybe not a surprise on that property?
Well, I think it's important to, what I found is to understand who the seller is. Sometimes you're so focused on the property and what it's doing, but the seller has a lot to, what I personally feel has a lot to do with it too, because how well they're organized and have the books gives you a really good picture of what's possibly hiding in the property as well. Mm-hmm. Through due diligence, it was pretty solid due diligence, but one thing that we noticed is that the sewer system was not up to par, and so that was after the fact, which we got it handled. But one lesson learned for me is to make sure that whoever's doing due diligence is a thorough due diligence, so there's no surprises. We got very lucky that there wasn't a lot more that came out, because looking back, I'm thinking, oh my goodness, what I know now, I know that due diligence is critical and trying to understand what's going on with the property as well as the books and the seller.
Absolutely. The integrity of the seller is important.
Very important.
And the integrity of having a good general contractor / inspector on the property can save you a ton of money and headaches in the future. Mike?
So we talked about a seller with high integrity and good books and a pretty clean property. So let's talk about the deal we just did.
Yes. A little different.
So Jess and I just with the loan. We closed, about a week or 2 ago, I guess now?
2 weeks, yes.
So we're sitting here the middle of July of 2016 now. So a little bit less than a year after you bought Highland Oaks, you go back to Oklahoma City, mm-hmm. and you look at another property called Country Village. Mm-hmm. Maybe talk a little bit about what re-attracted you back to the Oklahoma City market versus kind of staying around home in DFW.
Sure.
The property, kind of just set up how you got the deal.
Okay, so through my travels to Oklahoma City, like I mentioned, it's if you don't have a buyer broker, it's important to build those relationships with brokers. This is a relationship business, and I was able to build a good relationship with a local broker, and she would always inform me of opportunities out there that she felt were pretty strong, and I felt confident that she was shooting straight with me. And so this property is actually 30 minutes south of Oklahoma City, which is in Norman, home of the University of Oklahoma. And when she first took me to this property, she actually met me at a local Panera and had to prep me before we went on property of what to expect of this potential property, which made me nervous. I was almost like, well, maybe we shouldn't even go to this property because you're scaring me a little bit because you're having to prep me off site before we go. And so basically saying, look, think about the vision, blah, blah, blah. And so I was like, okay, let's take a look. And so she prepped me for it. And what I understood is that there's some owners, I'm sure throughout the country, that don't take pride in ownership as some of us do. But where that's bad, in some ways, that's good because it allows us to have opportunities to buy. So this particular seller lived in California. He was interested more in the entertainment business, Beverly Hills, and really was not interested in managing this property correctly. So as soon as we drove up, you could see immediately that the curb appeal, no signage. There was grocery carts at the front. The landscaping was terrible. Trees haven't been trimmed in a while. And so immediately, if you're an investor, you can immediately think, oh my goodness, this property's a dump. It just looks terrible. But one thing I noticed is that I felt like it was in a strong neighborhood and that this needs a little bit of lipstick and rouge, as they say. And so notice that I was preparing myself for what I was going to see on the inside. So basically, we were ready for the tour. And when we showed up, there was no property manager on site. And so we had to wait for an owner, which I thought was odd. 100-unit property, you expect a property manager to be on location.
Sure.
Which was very strange to me. But what was funny is you could walk into the office. And so immediately I knew that was an opportunity because if there's not a property manager on location, that's an opportunity where you can come in here, put a professional management company in and actually bring rents up immediately just from that alone. So basically what the seller was doing is he had a fax machine in the office and it had a sign right above the fax machine that said, for current tenants, for prospective tenants. For current tenants, for any issues, please fax in your problem. For prospective tenants, please send in your application for renting the property, which I thought was very, very odd. And so that's when I knew that there was an opportunity there.
So say that one more time again.
Sure.
You're telling me that there was a fax machine. Somebody would have to fill out an application.
In 2016,
100 unit, 2016. You walk into the office. There's no property manager and just a fax machine, not a computer, nothing. A fax machine with two signs that say, if you're for prospective tenants, for current tenants. And if you, in order to have something repaired on your unit, you fax in the problem and they'll take care of it. It goes straight to the maintenance man. And if you're interested in renting and seeing a property, you fax in that who you are and your application. And this is how no human interaction, which I find fascinating.
Unbelievable.
Unbelievable. So right then I knew, and what was more interesting is if this was more than 90% occupied, how is that possible? Why it's possible is because the guy was way below market. And so somebody was willing to send in a fax for $100 drop in their rent. And, I don't know if I'd have noticed this. I think if I was my first deal, I probably would have ran because it was scared me about that way it looked. This has made me nervous. But being in this business, not for extensive amount of time, but for enough time to understand that there's an opportunity here.
Yeah, that's great. And that's a good point, right? So you see, I own a few properties, and the best property I ever bought, they didn't have a computer in the office. It was just typewriters. So you walk into a property in the modern age and have a fax machine or a typewriter. A lot of people might run the other way, and guys like us run towards that. Yes. We know that there's anyone that's going to operate like that is definitely leaving some meat on the bone for the next guy.
Absolutely.
So we get into the property. We decided to go, since it's an Oklahoma City metro area, that is a pre-review market for Fannie Mae. So meaning that Fannie Mae lowers the leverage in that market due to the concentration or whatever economic issues of the area. And so we decided to go with a Freddie Mac loan, a Freddie Mac small balance loan. And through that process, I think we've encountered a few challenges along the way.
Absolutely.
Maybe kind of talk about some of the financial trends and some of the things that this fax machine owner was doing or not doing to the property, and maybe kind of just talk about that, like doing the due diligence, some things you found physically in that.
As you guys know, that Freddie and Fannie obviously like to look at a trailing three that's trending up. When we first looked at the financial of this property, it was. And that was back in April that the trailing three was trailing up. Well, what I think happened is, let's just say the trailing three did not continue to start trending up. It started trending down. And one reason we thought is this seller pretty much was 1 foot out the door. He was not interested in keeping the property running at its current condition because he was ready to just move on. Which is pretty funny because honestly, I'd rather have a property that had less leases that were less than market rent than trying to fill up a property above 90%. But this property was trending down. The occupancy was right at 90%, and it needs to stay to be stabilized. It needs to be over 90%. And so when the May numbers came out, they were not looking good. Mike and I looked at this, and we were a little concerned about that. And so when you're applying for a Freddie and a Fannie loan, it's important that these financials are going in the right direction, as well as that the property is stabilized and continues to be over 90%. We conveyed that message to the seller, but the seller continued to say, well, this, you know what you guys got into. This is your problem now. And so that did not help us. And so we were very nervous in knowing that this was something that we were saying, okay, do we stick with this type of loan?
We ended up getting a backup bank involved and got a good loan quote, good application. And we were able to put a little bit of pressure on the primary bank, and they were able to come through and get the loan done as applied on time, which was a pretty big success story along the way.
Absolutely. It's funny how it's a roller coaster ride, and they need to understand that during due diligence with inspections, with getting the loan, it is a roller coaster ride, but you just got to see through it and understand that you do got a good team involved, especially your lender and your mortgage broker, that they're top notch and they can work through these issues, in which they did, and we were able to close on time, which we are very excited to do.
Yeah, definitely. And this was a challenge. You also, I think you got somewhere around $150,000 seller credit too during the sewer system.
Yeah. So back during due diligence, we noticed that there was some sewer issues, and we inspected 4 of the 14 buildings, and there were some sewer issues. So basically, we got a quote on those 4 and applied it to that. We pretty much assumed that all units, all buildings were like that. And so my other 2 deal sponsors were a little nervous to come back to the seller and say, hey, we need $125,000 credit towards this, knowing that there's backup offers on the table. But what helped here is the relationship we had with the broker and explaining to her that we're not the type of buyers that are retrade, that we don't like to retrade. But when it comes to situations like this, you cannot see sewer issues on a walkthrough.
Sure.
And so we were able to negotiate that $125,000 credit, in which they gave it to us, which was outstanding. I think it helped that the agent we had a relationship with, and that she was able to convey to them that these guys are the real deal and we'll get this done. Just give them the credit.
Did you get the 125 as a lowering of the sales price, or did you get it as a concession that came back to you in terms of cash to put money towards that specific item?
No, we had to actually lower the sales price in order to get this done, which we had a conversation with them, and that was the only pretty much way we did it, which was fine. I mean, either way, obviously it lowers a little bit of the loan proceeds, since it's 80% of purchase price, but it didn't affect it that much.
Mike, tell us a little bit about that loan.
Yeah, so we ended up going with the Freddie Mac Small Balance Program. So you chose a 5-year option, I believe.
Yes,
is that right?
5-year option, yes.
So the way the program works, Paul, maybe you can compare and contrast it to the Fannie, but they had an option of a 5, a 7, or 10-year option, and that also a 10-year hybrid. But the Freddie Small Balance Program kind of competes a little bit more with like a bank loan, almost more than it does a Fannie Mae loan. It's not recourse like the Fannie Mae loan is, but they have it's like step-down prepayment penalties, and then it's like Justin mentioned, it was 80% of the purchase price. It didn't allow them to roll in the capex of the loan. But with his business model, it worked out that they were able to kind of self-escrow the renovations that they needed to do, and it worked out and hit his projected returns and everything he needed to get the capital raised for it. But it was a pretty good product, but it allows some flexibility on the exit. He can sell it without having a big yield maintenance prepayment penalty, and the loan is also assumable as well. So he can, if he does want to sell it with the loan in place, someone could come in and assume it. But most likely he would just offer it free and clear and pay the loan off early.
And you did a 5-year term. How come you didn't do a 10-year term?
So the business plan on this pretty much called for us to come in there with a professional management company, take care of the deferred maintenance, add some professionalism through some nice signage, and pretty much turn this thing in 3 years. And so we felt that this was more of on the shorter scale term hold than your typical 5 to 7 years like you hear. And so through that, we wanted to find a loan that had a lower prepayment penalty on the sale of the asset.
Yeah, I can't emphasize enough in saying that you got to know your exit strategy is on the front side, then just kind of figuring it out on the back side, and hopefully you were correct. This last 2 months or so, we've seen some transactions that we have financed where the seller had to pay $1 million yield maintenance penalty, large prepayment penalty. We've had a seller pay $850,000 as a prepayment penalty because they chose the wrong financing on the front side. So if your idea really is to sell this property and not have anybody assume the note, but actually sell it and put the loan to bed, that you may incur a large prepayment penalty, then that's probably the wrong loan for you to do. And so you need to have a good conversation with your loan officer and kind of make sure that your timing fits what your business model is. So your timing on your loan fits the business model that you want to work with. Anything to add to that?
Yeah, that makes a lot of sense. Maybe you can kind of compare and contrast two things here. So this was your second property, Country Village was your second property in Oklahoma City that you led. How did that work where like when you did your Highland Oaks deal, you had to bring in two other people that were experienced, help get the deal done. Now that you had ownership experience, kind of who was on your team maybe, and kind of talk about the capital that you raised, maybe kind of compare and contrast the difficulty level of the first deal to this last deal and the ability to raise capital and track KPs.
Well, once you get the first deal on your belt, it does two things. It ups your confidence because you understand this business more, but then also gives you credibility with passives and additional KPs and deal sponsors. Through my mentorship group that I'm in, I was able to bring two additional deal sponsors on that are not as experienced as I was, that helped out with the risk that is associated with getting in a deal. Most people think that, I can get in a deal. There is a little risk up front with escrows and costs that are associated with attorney fees and all that. And so, with that, I brought in two additional deal sponsors that could help me with that. That also could help me with the workload in regards to due diligence and things that are involved in the whole purchasing process. And so those guys are my partners on this deal. And I think that it's important to bring in partners and deal sponsors that you can get along with, that you feel comfortable with, because as you know, I've been in doing business since 2003, and understand that partners can either make or break a business. And it's important to understand that you have people that not only experienced, have liquidity, have net worth, but that you can get along with and that you can separate tasks and get those things done. And so I felt like I brought in two guys that are strong partners in that form and will do a great job with me moving forward.
And you said you raised about $1 million on the Highland Oaks deal. About how much money did you raise here?
A little over 1.2 million.
So a little bit more. And then the timeline it took you said before was about a month.
This was a week and a half.
About a week and a half.
Yeah, so a little different.
Fantastic.
Yeah, that one. It was a little easier. Sure.
So just to reiterate, drive the point home. Like Justin mentioned multiple times here. Paul and I both firmly believe what Justin just stated, that this is a team sport. You don't need to know everything about everything. You just need to know where to go find the resource that can help you through that specific task, whether that be your mortgage broker like Old Capital or your management company or your lawyer. You just need to have team members on your team. And then Justin drove the point home very eloquently. I think it is a relationship business that he had the foresight to, before he was ready to do a deal, he got into a couple other deals, gained some track record, and then all along he's networking with other potential passives of deals. I'm sure you met someone along the way and you said, hey, I'm going to go lead a deal in a year. This is my goal. This is my mission. Here's what I'm envisioning. If I get something like that, would you join my team? Is that essentially how you did it?
Absolutely. Just through building that relationship on a personal level as well as a business level. It's not all business sometimes. You got to get to know the person individually. And then when it came for me to tell them, hey, this is what I'm looking for. If it looks like the numbers are right, would you be interested in joining me? They're absolutely on board because they knew who I was. Yeah.
And so like Justin said, he was able to raise $1.2 million in a week and a half, right? Mm-hmm. And some people might think of that as intimidating or I can't do that. But, if you really take a step back, it really wasn't a week and a half. Justin had 2 years in apartments, but it was really 10 years in professional business along the way that led him up. And everything was like a series of baby steps, like Paul said, or like I like to say, kind of climbing a rung of a ladder. You got to go one rung at a time. And then eventually, now the next deal you look in, I'm sure you're not going to be looking for a $1.2 million raise. You're probably looking for a $2 or $3 million raise, exactly. Right?
Absolutely. From this point moving forward. I'm continuing to build that confidence that I can do bigger deals. And so for the next deal, looking for 150 units and up, which will probably lead to a $2 million raise or more.
So after you got your first transaction, now you're getting your second transaction in that Oklahoma City market. Are you starting to get some traction with other brokers that are starting to see that you're making a position in Oklahoma?
Yes, that I get a lot more. Instead of seeking, they're seeking me and showing me deals that they have available, knowing that we've closed on a few deals now. It definitely becomes easier as you continue to go in this business because people know you're for real.
And like I said, like I like to say, or I don't know if I mentioned on the podcast or not, but when I'm doing some speaking, this business isn't like a linear business. It's exponential. So it's not, that first deal is so much harder. And once you get that first deal done, the second deal is exponentially easier to get done. It's not a little bit easier. It's 10 times easier because you have a track record. People know that you're real. The brokers take you seriously. And then you have experience and you've learned, some minor mistakes like Justin mentioned about the sewer system on the first property. And he, took his lumps, he survived, and he moved forward. And that's, kind of talking back through this maybe, Justin, before we started talking and recording the podcast, we're kind of talking about getting put in a position, where you had to go hard with some earnest money and having some pressure on it. Maybe kind of recap your experience from in business from when you first kind of started, maybe some of the challenges along the way and kind of how you overcome it.
Absolutely. So, starting right out of college, starting out of business, I was very green in this whole arena of business. And when challenges started to come my way, I would a little bit of panic and not know what to do. But it's funny, looking back, situations like that define you and they create you and they make you better as you progress, because what happens is you end up finding a way to get through it. When the pressure's on, you stay up at night, you can't sleep, but that's a good thing because that helps you have ideas. Ideas flow through your head on how to solve this issue. And looking back now, 15 years later, I see that every tough situation that I've been encountered with, I've been able to get through and I've been able to understand it. And it's made me that much stronger and it's built me up to the position where I'm at now. Multifamily is no different than any other business. You're going to have a roller coaster ride trying to find and purchase deals. And then as soon as you get one, you're going to have a roller coaster ride as far as due diligence, getting the loan. And I think the ones that are successful are just break through that barrier and continue to move forward and continue to get to the finish line. And then just once you have your goal set of where you're going, it doesn't matter. It's like, okay, what's next? Let's break through this and get through it. So with that mentality, I think it helped me understand that I'm just going to continue to press on to make this happen.
So talking about the stress and things that keep you up at night, and so just between Mike and I, what's the 2016 State Fair winner that Justin Martinez is going to bring out? You don't have to tell everybody. You can just tell Mike and I.
I would love to. I'd love to. If this podcast was posted about 3 months later, maybe I would do that.
That's good. Well, to reiterate what Justin just said, I like Justin. Justin's got a motor to him, and he likes to. He works hard. He's focused, and I describe it as like he only has one direction. That direction is forward.
Right.
There's no reverse in him. He's just going to go forward, and he sets his mind on something. The challenges came up along the way. We had to kind of, tap the brakes a few times along the way, figure it out, but we kept going forward. And if I can leave everyone listens to this that's aspiring to get into it or is getting frustrated because they put in an offer, they don't get it accepted. That happens along the way. You just got to keep going forward. You got to keep, take your lumps, pick yourself up, and you move forward. And eventually, if you keep doing that, you'll get good things and accomplish good things. And as long as you surround yourself with good team members along the way, that can overcome a whole lot. So,
and make sure you just get yourself educated. I mean, Justin has a good mentoring program that he's part of, but also to, listen to the Old Capital podcast.com, oldcapitalpodcast.com, and make sure that you send us an email at info@oldcapitallending.com, info@oldcapitallending.com, just to capture our white paper report on financing 101 for apartments. Anything to add to that, Mike?
No, yeah, I think that's a good resource. We don't promote enough on here, but if you guys send the email in, you get about a 10-page document, kind of just the blocking and tackling, the basics of how loans get done, and at least give you a base level education. So when you're going out and trying to progress forward, you have a base level education. You can speak in some jargon and some terminology, and that's probably one thing that Justin kind of resonate with. When he did his first deal, he didn't know anything about it, and now he's using industry jargon. And when you come out and you can speak like that with a potential broker or a seller, they take you a lot more seriously. And if you're stumbling around with that jargon and industry tech terminology, then you instantly kind of put in the poser category right out of the gate. So I think that's a good resource that we have that we don't promote enough to it. So Paul, if you have anything else, if not, Justin, really appreciate you coming by today, and thanks for joining us on the podcast.
Thank you for having me.
Thanks, Justin.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.